Welcome back to Stock Spotlight. I'm Michael, your guide to the stock market. In typical episodes, we analyze companies that have earned a watch or buy rating on my 33-question research checklist. Occasionally, we'll discuss other topics related to investing. Today is one of those days, and we'll explore my strategy for entering new positions, combining fundamental analysis with technical precision to optimize the timing of my long-term investments. I will also share strategies for creating effective portfolio tracking metrics that simplify the process of monitoring your investments. Get ready to elevate your investing game. This is Stock Spotlight, where we transform market noise into clear signals. The first thing that I think about when entering a new position is running an initial assessment. The company must pass my 33-question initial investment checklist with either a watch or a pass rating. Ideally, they should score well on Guru Focus or Schwab, with Guru Focus carrying more weight. From there, I like to evaluate if the company is what I deem a quality growth company at a reasonable valuation with good technicals. In my opinion, portfolio moves should first and foremost be for the sole purpose of maximizing the quality of your portfolio and then the valuation. In terms of what I look for with a quality growth company, my definition of a quality growth company is a company that can reinvest capital at high returns, show strong free cash flow per share growth, maintain low debt, boast high margins, and possess a competitive edge. I look for competent management that's capable of fending off new competitors. Ideally, you would buy quality companies in bear markets or when beaten down through a bad quarter or bad news to maximize your return potential. However, it's often hardest to pull the trigger during these volatile times. So in the next section, we will actually review some technical analysis that you can use no matter what the market environment looks like. Other times to buy are when the company is priced at low multiples historically and within the competitive landscape. My goal is to build an individual stock portfolio of 15 to 20 high-quality companies with a watch list of 5 to 15 names. In my opinion, it's also okay to have some little positions, but they have to earn or beat their way into core positions. Once I've completed an initial assessment, I then turn to valuation and technical analysis. For valuation methods, I really have three buckets that I put valuation tools into. The first bucket is intrinsic value, and for this, I either run a DCF or a reverse DCF. The second bucket is a yields approach, and for this bucket, I actually have three: free cash flow yield, free cash flow margin, and adjusted ROE earnings yield. And then there's a third bucket, which is the multiples approach. For this bucket, I have EV to EBIT and EV to revenue. And all of these methods can be deployed depending on the company and its stage in the business life cycle. For intrinsic value, DCF, this is a classic valuation method that you learn in business school. And when using a DCF, I focus on four key elements. One, choosing an appropriate discount rate that reflects my desired return. Two, determining a realistic projection period. Three, making well-informed free cash flow forecast. And four, setting a reasonable perpetual growth rate. This last element, the perpetual growth assumption, is actually very crucial for the terminal value calculation and the ultimate DCF share price, and it really should be closely tied to the long-term GDP growth expectations. There are some companies like Hermes, which is actually in my portfolio, that may have a terminal growth rate above the GDP long-term average. Next, for intrinsic value, I'd like to talk about the reverse DCF. This is actually a very interesting one because I had never done this or heard it discussed in business school, and that's both at the undergraduate and graduate levels. Unlike a traditional DCF, the reverse DCF starts with the current stock price and works backward to determine what growth rate the market is implicitly expecting for the next 5 or 10 years. This helps assess whether the market's expectations are realistic. I will say that I've been using reverse DCF a lot more these days, and I think it's one that everyone should learn. For a yields approach, the first one that I'll talk about is free cash flow yield. I calculate this using either trailing 12 months or forward estimates for the next fiscal year and use enterprise value to account for net debt, although typical calculations that you'll see online use market cap as the denominator. Free cash flow yield is a crucial metric for assessing a company's ability to generate cash relative to its valuation. Free cash flow margin is underused, but particularly useful when I have reliable revenue forecast. It helps gauge how efficiently a company converts revenue into free cash flow. The last one for the yields approach is an adjusted ROE earnings yield. I actually wanted to include this because while I don't use it and am still exploring this metric, I think it can provide insights into a company's profitability relative to its equity value, adjusted for certain factors, which is relevant for certain industries. The third big piece of my investing valuation toolbox is a multiples approach. I'll first talk about EV to EBIT. This multiple is excellent for comparing companies that are already optimized for profits, as it takes into account both the company's debt and its ability to generate earnings. Some have asked why I don't use EV to EBITDA. While EV to EBITDA remains popular due to its simplicity and wider applicability across industries, EV to EBIT often provides a more nuanced and potentially more accurate valuation metric, especially for capital-intensive businesses or when comparing companies with significant differences in their depreciation and amortization expenses. I then like to look at EV to revenue. I use this multiple method for companies that are not yet optimized for profits, such as high-growth tech firms. It's particularly useful when evaluating businesses in their early stages or those prioritizing growth over immediate profitability. Then, technical analysis is the final check before I enter a position. I like to run each company through a variety of the valuation methods, and if they're relatively reasonably priced, which is a subjective decision for all of us, I'll then usually buy a starter position and have them earn their way to a higher position in my portfolio. But before doing that, I like to look at technical analysis, and this really serves as the crucial final step in evaluating a potential stock position. It combines price trends, volume patterns, and general market dynamics to help us inform entry timing. The first bucket that I'll talk about for technical analysis is moving averages and trend identification. So technical analysis is really helpful to determine trends. And one way to do this is to compare the current price to 1 year and 5 year, 200-day exponential moving averages, which are also called EMAs, to identify short and long-term trends. A stock trading above its EMAs suggests an uptrend, while if it's trading below, that indicates a downtrend. The distance between the price and EMAs can actually signal the trend strength, with large gaps potentially indicating overbought or oversold conditions. Additionally, you want to examine the slope of the EMA itself. A rising EMA reinforces an uptrend, while a falling EMA confirms a downtrend. The best time to enter a stock is during stage 2, which is the markup or accumulation phase, where the stock breaks out above resistance with increased volume. Stage 2 is characterized by a clear uptrend, with the stock making higher highs and higher lows. The price typically trades above rising moving averages, and volume tends to increase on upward price movements, confirming the strength of the trend. Speaking of volume, the next thing I want to talk about with technical analysis is that it's really helpful for volume analysis, and volume provides crucial context to price movements. High volume accompanying price suggests strong buying interest and trend continuation. Conversely, price rises on low volume may indicate lack of conviction. You can analyze volume from both a daily perspective and a specific price level to gain a comprehensive understanding of trading activity and market interest. The final area of technical analysis for beginners is understanding support and resistance levels. The previously mentioned EMAs often act as dynamic support in uptrends or resistance in downtrends. Price interactions with these levels can signal potential trend reversals or continuations. Additionally, identify key price levels where the stock has repeatedly found support or encountered resistance in the past. You want to pay attention to what they call volume shelves, which are areas of significant historical trading activity that can act as support or resistance levels, influencing future price action. By integrating these technical analysis components, you can gain a comprehensive understanding of a stock's current market dynamics, which helps you make more informed decisions about position entry timing and risk management. Once I have purchased shares of a company, I like to add them to my investing portfolio spreadsheet. And this spreadsheet has a lot of different things, but one thing today we'll be talking about within it is portfolio tracking metrics, but also get into formal investment thesis development and some qualitative tracking measures as well. First, I want to call out that before adding a company to your portfolio, what I would do is create a formal investment thesis, and it just has to be between maybe 2 and 5 sentences about why you bought the company and why you think it's going to win long term. Once that's been done and you've purchased shares of a company, I would outline just 2 or 3 KPIs that you can monitor investment progress on either a quarterly, biannual, or annual basis. Now we'll talk about some qualitative measures and some quantitative tracking metrics. The first thing that I like to do after purchasing a company and adding them to my investing portfolio spreadsheet is to identify its stock type, which I've got as either owner-operator, monopolies and oligopolies, share cannibal, or disruptor. These are the type of stocks that I like to invest in, and I have 4 buckets of types. Stock types help classify companies based on their business model and competitive dynamics in the market. For management, there's 2 things that I like to do. The first is I like to classify them as either founder-led, long-tenured manager, or a hired hand. This classification system is based on knowledge and passion for the business, with it starting from founder-led to long-tenured manager, which I've got defined as 10 plus years in the industry, or a hired hand, which has limited experience. And then I like to look at insider ownership percentage. This reflects the shares owned by insiders, indicating their commitment and confidence in the company's future. My portfolio weighted average is 11.1%. Ideally, I like this to be around 15%, so it's something I'm hoping to increase in the future. The next area of my spreadsheet is performance. The metric that I use here is the non-inflation adjusted historical price return CAGR. This is from Portfolio Visualizer, and it indicates the historical price performance on an annual basis. My portfolio weighted average is 12%, which does include some index funds and ETFs. I then go into a volatility and correlation section. The first thing that I put for all of my holdings is its current beta. This indicates the holding's volatility relative to the overall market. Research seems to indicate that the lower the beta, the better performance in the long term. My portfolio weighted average is 0.86, and this does include index funds and ETFs. The second section is its historical market correlation. This assesses how closely the stock's movement aligns with market trends, which is useful for diversification strategies. My portfolio weighted average is 0.63, which does include index funds and ETFs, and it should go down over time as I increase managed futures as a percentage of total portfolio. I then have a section on revenue growth and exposure. From here on out, these metrics only apply to my individual stock holdings. The first one is 10-year revenue CAGR. This shows revenue growth over 10 years, indicating a longer-term business health. And my 10-year portfolio weighted average is 15.2%. I then go into the next 2-year average revenue growth forecast, which provides insights into future business prospects and market positioning. My portfolio weighted average is 11.9%. The last thing that I like to look at from a revenue perspective is the percent US versus non-US revenue breakdown. This provides insight into geographical revenue exposure, helping assess market risk and opportunities in different regions. My portfolio weighted average is 44% US revenue and 56% non-US revenue. I then like to just have 2 metrics for margins. The first one is gross margin. I first look at a 10-year average gross margin and standard deviation, which reflects business model and pricing power. I then also pull trailing 12-month percentage for a more recent view. My 10-year portfolio weighted average is 56.0%. I usually like to buy companies with a gross margin of at least 40%. I then go into free cash flow margin, which I do adjust for stock-based compensation. Free cash flow margin reflects the percentage of revenue converted into free cash flow, which highlights a company's cash generation capability. I first pull a 10-year average and standard deviation, and then also look at a trailing 12-month percentage for a more recent view. The 10-year portfolio weighted average for me is 16.5%. I usually like to look for over 15% in new companies that I add to my portfolio. I then have 2 sections on free cash flow, and as you can see, it's very important to me. The first is free cash flow strength. I break this down into free cash flow linearity and free cash flow conversion. For linearity, this shows the consistency and predictability of free cash flow growth over time. Ideally, this metric should be over 75%, with my portfolio's weighted average a little higher at 78%. For conversion, this is just free cash flow per share divided by diluted earnings per share. It indicates cash generation efficiency and sustainability. I pull both a trailing 12-month and 10-year average, and my 10-year portfolio weighted average is 103%. The next free cash flow section is free cash flow growth and valuation. For growth, I pull a 10-year free cash flow per share CAGR. I like to use free cash flow per share because it's on a per share basis, which accounts for stock-based compensation. And my 10-year portfolio weighted average is 21.2%. Ideally for me, this would be higher than revenue and double digits. I then pull two metrics on a forward-looking basis. The first is a 5-year forward free cash flow yield. So my calculation of a forward free cash flow yield projects free cash flow per share 5 years out based on the last 10 years of data. And this is calculated using Excel's forecast feature. And I usually apply either linear or exponential regression. This metric is really nice to use and perhaps the best metric to use to judge your portfolio because it does balance both growth expectations with current valuation. From there, I like to also just add in a new row for the lower confidence bound. And this is the 90% lower confidence bound of the forward free cash flow yield, providing a conservative estimate to account for potential cash flow variability. I then like to analyze the 5-year forward free cash flow yield against the 10-year average free cash flow yield to provide that historical context and benchmark that helps me determine if a company is over or undervalued. You can also look at the 10-year treasury yield and industry comparison. The next section as part of my qualitative tracking metrics is value creation. And for this, I just use ROIC percentage. ROIC measures how effectively a company generates profits from its capital investments. There's many different ways to calculate it, and I like to use stockanalysis.com and quickfs.net as they have slightly different methodologies and just average those two together. I like to pull the average ROIC over 10 years with a standard deviation and also look at a trailing 12-month percentage for a shorter term view. My 10-year portfolio weighted average is 23.8%. I usually like to look for anything over 20%, and I think the top quartile benchmark for my database is around 22 or 23%. The next section is capital intensity. This is just the CapEx divided by the revenue on a percentage basis, and it indicates how much a company's revenue is being allocated to capital expenditures and really helps assess investment in growth versus returns. I pull a 10-year and a trailing 12-month percentage. My 10-year portfolio weighted average is 4.6%, and I usually like to invest in companies that are below 5%, which indicates a capital light business. Next, I like to pull investment intensity, which takes the CapEx and divides by the depreciation and amortization. This assesses whether a company is investing adequately to maintain its asset base. I like to pull the average on a percentage basis over the last 10 years and also look at a trailing 12-month percentage for a shorter-term view. My 10-year portfolio weighted average is 118%, and I usually like to invest in companies consistently above 100%. The last section that I have is financial strength, and there are two metrics that I track on this. I will say that there's plenty of other metrics you can choose. I know net debt to EBITDA is popular, cash to debt, or lots of other metrics for solvency and liquidity. But the two that I track are 5-year average interest coverage ratio and is the company to net cash position as of the latest quarter. The first one, interest coverage ratio, this measures how well a company can cover its debt interest obligations based on earnings from the previous year or trailing 12 months, and it indicates overall financial stability. My 5-year portfolio weighted average is 30.2, which excludes an outlier in Nintendo. For the net cash position question, this evaluates whether the company has a net cash position compared to its debt, which indicates insight into financial flexibility and overall risk management. As of the latest quarter for each of my portfolio companies, 55% are in a net cash position. Thank you for tuning in to this episode of Stock Spotlight. I hope you found valuable insights to enhance your investment buying strategy and portfolio management. If you enjoyed the episode, Please subscribe, leave a rating, share your thoughts in the comments, or take our episode poll. Your feedback helps us improve. For real-time updates and insights, follow me on X at invest091. Join me next on Wednesday, December 4th, when we'll dive into Autodesk Inc., ticker symbol ADSK. Until then, keep your investment smart.